Welcome to the latest installment of the Long Only Podcast. I'm Doug.
Gerry,
Gerry, how's it going?
it's going good, Doug. How you doing?
I'm all right. You heard all my complaints over lunch
Yes,
that you paid for.
Doug doesn't agree with anything I agree with on music, but we won't go there.
Pretty much.
Well, not anything.
And
It's okay.
Gerry won't let me write funny messages on the whiteboard behind me. So that's somehow we managed to be friends.
You do sound far away, though.
Do I?
You do.
Let me just making
I don't know.
corrections in real time.
Is your volume turned up?
I think so.
Anyway, it's fine.
All
I
right.
hear you.
We'll make it work. You can hear me okay.
I hear you.
All right. Still working out video. Gerry, where we are today. It appears.
So I think last time we talked about. I hate making predictions, and here I am making predictions. I think I said I thought rates had peaked, interest rates had peaked. Today I'm going to say I think, generally speaking, stocks have bottomed.
Okay.
Or maybe the better way of putting it is the next major move in stocks will be up. Now, when that's going to happen, I don't know. But I think that, and so therefore, there, could there still be some more downside to go? Yes. But I think as far as major moves, so I mean, a move up 30%, I think it's up. So a move like that will be up. It's just where it begins from.
Why do you think that, though? More importantly.
Well, for one thing, I think if nothing else, we're going to get, for lack of a better term, goosed by lower interest rates sooner than people think. I think
probably
that we're
because it's election season coming up.
There's that.
Yeah.
Which is not a good reason why.
No, definitely a mixed bag.
Yeah, I also think further along, we may be setting up for a 1970s style reversion back to some sense with respect to policy. Remember, the 70s was horrible, and we went through 10 years, right, of relatively high interest rates, ever rising inflation. Remember the whip inflation now? You might be too young for the whip inflation now. The win button. Whip inflation now.
I remember 8 is enough. That's pretty bad. In the 70s.
I don't think was that the 70s. I thought that was more like early 80s. But whatever.
Yeah, I started in the 70s.
Okay, you're our pop culture guru.
Yep.
So I think that a couple of things are playing into it, and what nobody's talking about, but if we have a major political correction in there, and with that a major policy correction, kind of along the lines of the Reagan Revolution, which brought us 30 years of prosperity, that could be significant, because there's what's different now than then is there is a lot of very significant things happening technologically that make businesses far more efficient. I mean, what we're particularly impressed with right now, and it's not to say that every single company is doing great. They're not. There's struggles out there. But in the aggregate, we're really impressed with how well companies are doing in a very difficult time. The well-managed companies thing matters. In front of fertile fields of future growth, to say 5 times in a row. So, if we do get any kind of reasonable policy correction, which is going to have to come from a political correction, because right now we don't have that. We're holding the fingers are in the dike, holding it all off. And as I say, companies are doing a remarkable job. But just imagine if we had a less regulatory, burdensome environment. Just imagine if tax rates somehow got flatter and lower. Just imagine if people were the entrepreneur was unleashed on a much more level playing field than what we have right now, where incumbency wins a lot of times. Or let's put it this way: incumbency has the advantages, and therefore the bigger the company, the bigger the advantage. Cronyism isn't alive and well, unfortunately, in today's economy. So I think, to what extent that can be at least held off, if not reversed. If it's reversed, then Katie, bar the door. It's all it's all speed ahead, full speed ahead. So that's my my short version of the update. I think there's going to be we'll think about more of that kind of thinking, because nobody's really thinking along those lines. Nobody's thinking that they're so many things have gone wrong. Heck, for the 21st century. might there be a correction to the other side that is meaningful? I think there could be. And if there is, we could see with the combination of productivity that comes from the natural enhancements that we've been seeing from technology, as more and more, one of our major narratives is the digitization of non-technology enterprise. I think the number's something up until, say 5 years ago, for the previous 25 or 30 years, almost all technological advancement within company frameworks was done inside the technology sector itself. In other words, they were coming up with the technology and they were adopting the technology. What we're seeing now, and it's been going on for 4 or 5 years, is the digitization of that part of the economy that is not technology as far as their overall business, but is adopting technology and becoming much more efficient. And so I think that, and that those numbers are something like, 25% of the economy is technology, and they were adopting 75% of the technology. And now it's the 75% of the economy that's non-technology is now adopting technology and helping their business. And, it's not to say, and you and I would agree, and there's plenty that would also agree, some that would disagree, that there's a lot of things about technology that have not been as good as, and have hurt certainly the culture and society. But from a business standpoint, productivity enhancements that come from it are certainly real. And so that could be maybe a little bit of a positive spin on things that we don't hear much these days, but stay tuned. I think that could be very possible in the next couple of years to see, depending on how things go.
All right. So switching on to the next segment, we're going to cover an investment related topic today. And this is an investment that this is just for informational purposes only, because it's not something Gerry's a big fan of. But it's still important to know what it is, because it does have some impact on the market. Gerry, what is short selling?
So short selling is where a investor, or I would more loosely say speculator, even gambler,
evil person, freedom hater,
borrows somebody's stock. Somebody owns shares in XYZ company. They go to that person and they go to the broker that person has their shares held at and asks to borrow those shares. And without getting into the gory details of that, they do borrow the shares, which means there's a carrying cost for that. It's like borrowing money, but they're borrowing shares. And they sell those shares. So they don't own them, but they sell them. And the idea is that if the stock goes down, then they can buy it back at a lower price. So it's the revert. It's buy low, sell high, but you sell first and then buy and then buy it back later. Hopefully, in their case, they're buying it at a lower price. So they're
sell high, buy low.
They're rooting, sell high, buy low. They're rooting for the stock to go down, and it has to be done in a brokerage arrangement. It's not something that you can do outside of that. I mean, maybe you could. I haven't seen it. I'm sure there's a way to do it in some like a private format, but generally it's done, using a broker custodian, who also makes money on that, because they'll get the interest costs for that, and of course the trading costs of whatever trading costs there are for making the transactions. And so, yeah, I mean, it's simple from that standpoint. It's complicated from the standpoint of what it means for the market and what it means for shares of companies that do that. And in its simplest form, it's just simply borrowing someone else's stock and then selling it. It's a trading strategy. It's not something, because of the carrying costs, it's not something that you're going to do permanently.
Well, so on an individual basis, the reason that this oftentimes isn't ideal is because of the risk. Things can go down a lot faster than they can go up, even though the stock market does generally have an upward bias. So there's that element of risk that is really unappetizing for most people from an individual investor standpoint. But beyond that, why don't you like short selling?
Well, I don't find any economic interest in it. For my entire career, I bought into the idea that I've been told from everybody under the sun in the brokerage world that said, "Oh, it provides liquidity. Oh, it's disciplining management." And in other words, management is awry. It's the short sellers that go out and find out if that's happening, and they then short the stock, and that keeps management honest because they have to worry about what the ramifications of that are. I find that disingenuous. I find it, and especially because nowadays, and I don't want to get too much into the weeds, but it's much easier for shorters to short than it used to be. And I won't get into the technical reasons for why that is, but there are rules that were in place that kind of kept shorting from being able to be to run amok, if you will. I still think it was problematic, but it wasn't as problematic as I think it is today. And in a less liquid market, it doesn't take much for it. And what we see all the time are these short sellers that are out there floating stories about companies that end up not being true. In some cases, I would argue they're fraudulent, but nobody can ever prove that because they're always able to fall back on, oh, well, it was our opinion. I mean, I can go out there and yell, fire in a crowded theater and say, oh, well, I thought I smelled smoke. It's kind of like that. And that's essentially what these folks do. And they're often attacking the small companies that can they'll afford to have their stock prices being hammered, because that affects their ability to raise money in the capital markets. I think it's become more and more pervasive, and so more and more I've kind of evolved into saying I truly think short selling should be illegal. It shouldn't be part of the market. I don't need a short seller to discipline my management. I'll do that myself, thank you, as a shareholder. Shareholders don't like what the management is doing. They sell the stock. But that's short selling. And that's a very short version of why I don't like short selling. I don't like it. And of course, I'd be accused of being biased because we're, as in this podcast is called the long only podcast. We are a long only shop. But we're doing it because we want to invest in businesses, whether they're public or private or whatever. And we're not interested in this trading mentality. And short selling is the epitome of a trading mentality. And I just haven't seen in my coming up on 4 decades in this business, I have not seen the economic benefit other than to those people who are doing it. And I often wonder if even they benefit that in the long run from this, because it's, I mean, I'm sure they do. Otherwise they wouldn't be out there. So
these tales of talking about the economic benefit, sounds like justification. This is a practice in search of an explanation for the practice when they're giving out their economic benefit.
Well, and the explanations of disciplining management and liquidity are the things I always hear. That's what I always hear.
That's how everything is justified, though, it seems like these days.
Oftentimes.
So, liquidity, yeah. I should say, in particular.
Liquidity, price liquidity to the market, provides liquidity. Anybody who sees the volatility that's going on, especially in smaller companies today, and suggests that there's perfectly reasonable liquidity is not paying attention.
I think this much is not very controversial. You can have a long, happy life as an investor and never engage in short selling. I think many
most
people
definitely
agree with that. So,
and I will emphasize too, as truly long-term investors, at the end of the day, it shouldn't matter that much. But there are real cases of companies that have been taken out, and we're not we don't tend to be and have never been big biotechnology company investors, if at all, really very almost none. But that is an industry they pick on, and they've taken some companies out, and it's not to say that every company out there is lily white and crystal clear, perfect. But I think there's a lot more nefarious activity going on the short selling side of things. I'm sorry, and we've witnessed it for so many years and watched how it plays out. And you can write the script every time it happens. That float the story and all these terrible things about what this company, and they're often done with very, very well-written research reports that look like they're super serious, hashing out things that ultimately end up being proven in not every case. I'm not saying every case, but the majority of them that I've seen and end up being, nefarious or bogus, or if not outright fraudulent in what they're saying, or libelous or whatever. And yet there's really no there's no prosecution that can be won, I don't think, because again, it comes down to falling back on, well, it's my opinion. It's like a freedom of speech thing. Well, I'm more than happy to have you. You can say what you want, and I can disprove it or I can disagree with it. But when you're saying whatever you want in a way, especially with social media nowadays, and with the way people, shoot first and ask questions later, a lot of damage can be done to these small and mid-sized companies because of this.
All right. Close the door on that for this week. Now we'll head on to the personal finance tip segment of the week. It's pretty basic, and well, they're supposed to be basic, but we want to talk about the basics of company-sponsored retirement plans. The most important of them being the
401k plan.
401k. That's the most ubiquitous, the one we see the most often.
What most people are aware of or hear about or participate in their company.
Correct. Maybe in certain segments of public service, you have a 403b, but 401k is by far the most popular. So, Gerry, what should they know about the 401k?
Well, I mean, they should participate in it, and I think
there you go. Okay, right. And that actually could be in a lot of ways. That could be enough said.
That could be enough said.
Yep.
At the very least, most company 401k plans will have a component where the company will match, and the most common number I see is like they'll match up to 4%. So if you contribute 4% of your salary, your income, they'll match 4%. Now I think the numbers they've gone up over the years. I think it's up to 25% of your income that can now go into a 401k. And there are limits based on how much money you make.
It's a significantly higher limit than an IRA.
Yes.
So
significantly higher.
Yep.
Yes. And so in most cases, at the very least, people should participate to the extent that the company's going to match, because that's just free money. And, we hear a lot about the problems with Social Security, and they're myriad, but like, for example, if the money that people quote unquote put into Social Security, which is not really what's happening, it's a pay as you go system, and they're taking your money and giving it to someone else. And in the years when they were taking more money from people than they were giving, and there was supposed to be a trust fund, though they spent it. That's another discussion. But it is. Sorry, Doug, I accidentally made a noise. Not to get in a big discussion about Social Security, but if people had been able to put their money that they paid into the Social Security system, or they were taxed, it's a tax. The Social Security tax, put it into a plan similar to a 401k, oh my gosh, we would not have a Social Security problem at all. It would be just if it was put in any kind of reasonable, investment account over the years, we'd be actually in really good shape. In fact, that's one of the great arguments, I think, for how we can reform Social Security, is turn it into a true defined contribution plan instead of a defined benefit plan. But the 401k is one of the best tools people can use, and for saving for their retirement, saving for the future. It's it grows tax deferred, and it's taken out of your salary tax pre-tax. So it's taxed when it comes out. And there are points where you cross over, and some people maybe have more in that than they should, but that's getting really nuanced. And for the average person, that's not the issue. The issue is, this is a way for you to save. I mean, there's a lot of people, and we talked the other day about my favorite savings and investment plan, and I said that was over and above your retirement plans at work, and it should, and it is. And you should still absolutely be doing that. But for many people who don't do that, participation in the 401k plan, a company-sponsored retirement plan, is truly the only savings they ever have, or the only kind of investment savings plan they have. So at the very least, the bare minimum, people who are working for a company that does sponsor, and there's very few companies nowadays that don't sponsor some sort of retirement plan, especially if it's a company of any size, they absolutely should participate in that. It's a no-brainer, and even more so to the extent that they participate when the employer is matching, at least. So put the amount in that the employer will match. They put $1, you put $1 in, they put $1 in. It's a double. I mean, it's pretty hard to double your money immediately in any investment. So you put in the power of investing over time with the fact that the company's participating and giving you money on your behalf. It's a win-win.
I would say this is one of the few things in investing that is almost do first and then ask questions later.
Absolutely.
Because you're doing two very powerful things. You're always getting the money out of your own hand, which is a good thing for Americans. Yep. And as an American, I can vouch for that. And number two, you're generally getting some kind of match on it. So even
almost always,
it almost makes the investment selection secondary, whether it's cash, bond, an index fund, target fund, or something like that. That the power of getting out of your own hands and getting a match is so great that don't think about this, don't put it off. And that's why the reason why you're seeing companies more and more almost have it be a default. You have to opt out of the 401k for some companies. They almost take the Big Brother-esque stance of almost opting you in unless you opt out, which as far as bad things the government can do, that's actually pretty low on the list. So obviously we don't want to get too much into
it's a simple way of helping yourself.
All right. So last up, we're going to, I made a big noise when I pounded on the desk. Last up, we have our free enterprise saint/sinner of the week. And today we're going to talk about someone, not a Catholic. So the term saint probably isn't the first thing that would come to mind. Not a bad guy either. Someone who's had a lot to say about modern economics and economic thoughts. Friedrich Hayek, and his most famous book, which was, Gerry?
The Road to Serfdom.
All right, The Road to Serfdom. So what was The Road to Serfdom about? It's his definitive work, I would say.
Most definitely. And by its title, what he's going to explain to you is, if you don't do the things I'm suggesting, it's the road to serfdom. And what is the serf in a feudal society but the guy that didn't fare very well?
A tad prophetic.
Yes. So we're not going to get into details about the Austrian School of Economics, but he was shall I say, I don't know if member is the proper word, but a proponent of the Austrian School, which is a very classical, liberal, free enterprise, free market. I hate that word, but whatever, people understand it. Approach to economics, that the individual has the ability to determine their destiny by virtue of what their ability is to work hard, innovate, and how they are best allowed to flourish is when government gets out of their way. And a very important thing, this is not it's promoting anarchy. It's promoting, in fact, what I would say is the most pertinent point of the book is when he gives the example of the rules of the road, like literally when you're driving down the road. We want government to give us rules by which we can go wherever we want to go, but so that we don't have mayhem on the streets where one guy's driving on one side of the road and the other guy's coming the other way on the same side of the road and they crash. That we have rules where in the United States you drive on the right side, and a stop sign is you stop, and the guy on your right, if he's there first, he goes before you. All those rules help to keep us from crashing, but we're free to go take whatever route we want to take if we're driving from LA to San Francisco. That government isn't
Wait, why are you in California to begin with?
That's not very classical liberal, is it?
Yes.
All right, Phoenix to Flagstaff.
For now, it'll work. We'll see how the election goes.
All right, how about Dallas to Houston?
Now you're talking.
Okay, now I'm talking. So the government's not telling you must go from Dallas to Houston, or you must go to Houston today, and you must use this road. It's saying you can go wherever you want. You just have to follow these rules, and that's where we end up with a productive society. The least amount of regulatory encroachment from government produces the best results.
And you'll notice in those cases that the government, in those examples and those analogies you're using, was not determining the outcome. The participant was determining the outcome. The government was giving rules of the road for the process and the route.
If that's all you take away from The Road to Serfdom, you've got the book. You've got it down. what's remarkable, and this is just a side, we've done a lot of work with interns over the years, and from business schools who are taking the economics classes. And it has been nothing short of shocking to me that an economics student has never read Road to Serfdom.
Oh, I majored in economics.
Doesn't have any idea what it is.
No, nothing about the Austrian School of thought in economics.
Right. It's pretty much all Keynesian and neo-Keynesianism and modern monetary theory and all of that kind of stuff. That's for another podcast, I suppose. But nonetheless, it's when I would talk to young people in our internship program, I would always say, you're not going to hear this from your professors, but read Road to Serfdom. Read George Gilder's Wealth and Poverty and Knowledge and Power. Those are all. And by the way, it's not to suggest that the Austrian school was perfect. It's not to suggest that supply side is perfect. We certainly are not going to say that Keynesianism is perfect. Although there's aspects, Keynes himself was a business person.
That's why he changed his opinions on things.
Well, and would many others besides me have said this before me have said this, that would probably be rolling in his grave in seeing what has been done to the school of economics that bears his name. It's what we're seeing today is not something he would agree with, but he was much more of a believer that government action can be beneficial with respect to economic outcome, and an emphasis on economic outcome, which you just referenced a little bit earlier. Government shouldn't be worrying about the economic outcome, just leaving the playing field as level as possible. So hence Friedrich Hayek, and I think clearly a saint in the context of our Saints and Sinners for Free Enterprise segment. Definitely, it's an easy reading book. So, I mean, if anybody who has the least bit of interest in understanding Austrian economics and understanding how the economics works, reading that book would be very beneficial.
One of the hallmarks of the Austrian School of Thought is that it's not a mathematic-based economic system.
Not at all.
It's based on a priori logic. It's almost philosophical.
It's empowering the individual.
So, and these math to a lot of untrained people might sound, math means better. Math means factual. No, math can be tortured. So don't just de facto take the fact that something is math-based makes it true.
And you know more about that than I do, being a math major.
Well, I was going to say, case in point. Math is only as good as the assumptions that go into it. Case in point, COVID predictions.
Yeah.
All right. So sorry, we had to get something about COVID in. We do every episode. So this, I'm going to say.
The underlying horror that will be with us for decades.
So hopefully anyone who would have been annoyed by that reference had already stopped listening. All right. So let's get out of here, Gerry. And remember, people can find us at taylorfrigon.com. Also, Instagram is taylorfrigon.invest. And email us at longonly@taylorfrigon.com. Until next week, I should say. I'm Doug.
I'm Gerry.
And thank you again for joining us on the Long Only podcast.